Hi, this is Keith Schneider, CEO of MarketGauge.com, and it's September 16th, and this is the weekly market outlook. Please participate in our investor sentiment survey, and we'll email you the results. Also, if you like what you hear today and you like the text that you've read leading up to this, please sign up on our website and be sure to get the market outlook update on a weekly basis right into your inbox. So, lots of interesting activity in the markets, to say the least. The Fed delivered. There was lots of speculation that things weren't so bad as to necessitate a further quantitative easing, but the Fed felt it was necessary and basically has indicated it's going to supply endless amounts of liquidity to spur the economy. So let's see how the markets responded and where they are and what's likely to unfold in the next couple of days and the next couple of weeks. Well, first of all, as you can see, the S&P responded with in the last 2 weeks with a resounding vote of confidence. Additionally, you can see that the volume has, in the last couple of days, really picked up. And in fact, we've had 4 accumulation days in the last couple of weeks. That's definitely indicating a positive response. And not only that, institutions are now starting to accumulate. You can see going back all through this rally, rather weak volume, but what has materialized over the last 2 weeks since we've returned from summer vacation, that the market is moving up and on improving volume. Now, on the cautionary side, you can see that we've hit about 97 on our short-term RSI on a daily basis. So that definitely is a bit of caution, but only on a short-term basis. This is a very short-term RSI, and obviously the market has gotten a bit ahead of itself. But nonetheless, overall, market's in a very, very strong position. Furthermore, you have a couple things here. You can see that what I've done is I've outlined a channel here, and we've hit the upside of the channel. So the coincidence of hitting the upside of the channel, being overbought on the RSI, indicates certainly some potential sideways action or a slight down to work off this overbought condition. Let's take a look at the weekly charts. Weekly charts almost in the same type of scenario, not quite there. You can see we've now taken out a critical resistance level, making new highs for the year and going back several years, at least I think to 2007 or so. So you're definitely bumping up against the most recent highs. So odds are that you're going to see potential vacuum to the upside and really taking out the highs since 2007. Now, looking back at the S&P, you also have the all-time highs in the S&P just below 160 as rated by this ETF. So there's your next round of resistance, somewhere in the 155 to the 158 level. But that's 10 points away, another good 6-7%. So it's not going to do it in one fell swoop, but nonetheless we're in a relatively strong position. And again, you can see coming back from the summer doldrums, volume definitely picked up to the upside. Let's take a look at some of the market internals. First of all, VIX still in a bullish mode. We're still in the middle or within the Bollinger Bands, trading at the 14 level, 1450. So extremely positive. Sentiment is nowhere what we would consider irrational exuberance. We are trading beneath the 50-day moving average, beneath the 200, and again, in still the middle of the Bollinger Bands. You can say the exact same scenario on a longer term basis on the weekly charts. So again, from a sentiment level, still plenty more room to move and to the upside. So trend here is positive. Let's take a look at some of the market internals, because that is the thing that's the biggest fly in the ointment. But let's take a look first at our intermediate term indicators. The McClellan oscillator, as you can see, I've highlighted here what we would be considering the really extremely overbought level. So what's interesting, just with the rally in the last couple days, we're just starting to reach levels that if we started to hook down could generate a sell signal. But nonetheless, we're on a positive upward slope and still have plenty more on an intermediate term basis for the upside. Now, on a shorter term basis, looking at advanced decline and up-down volume on a 10-day basis, which is, looking out obviously over a shorter term, you can see we're hitting levels that are considered relatively overbought. But remember, things can get more overbought and stay that way. So until this thing hooks down, trend is extremely positive, just running rich. So we are susceptible to a correction. Now, the other thing to take notice is that so that was, advanced decline, this one here. Now, the up-down volume finally is starting to kick in also. So we're at levels that if it starts hooking down and it's confirmed by the volume as well, we'll definitely be getting a strong sell signal. But it's not there. Things in motion can continue in motion, and in this case, the trend is up, it's strong. Even a little bit of a correction might not be enough to get us to a sell signal. So again, running rich, it's a little bit of a red flag for me. So I would be looking to take profits at the first sign of weakness or any sustained weakness here, because the sell-off could materialize into something a little bit serious, and you don't want to give back profits, especially if you're a shorter term to intermediate term trader. So let's let's keep a close eye on these market internals, because if they start hooking down, you're definitely at a level where it can generate a powerful sell signal. However, we're going to let the market tell us what it wants to do. So we're not going to catch the absolute highs, but we will be out in time for a major correction and possibly to take advantage of some short opportunities if they present. This particular chart or these charts are really a combination of many different indicators. We call this the market tone. So just to give you a quick overview, we divide the market into two tiers, the S&P and the NASDAQ. And again, this is a composite of about 20 different indicators, both in the short term and the long term. And you can see on a short term basis, looking out for just a couple of days, that our indicator is actually neutral. So because we've been running rich, the composite of many different indicators are a bit neutral. NASDAQ a little bit stronger, and it just really worked off a very bullish reading. Now, taking a look at the bottom half of both the S&P and the NASDAQ composite indicators, they're looking, as we mentioned, a lot more positive. They're at the higher end of the spectrum, so trend still firmly intact. So in synopsis, are we potentially susceptible to a short-term correction of a couple days? Absolutely. Longer term, trend still intact. Now let's take a look at some of the, what's happening with the with various interest rates, the yield curve. We'll cover here as well. So the first thing, let's take a look at 30-year bonds. As you can see, in the 30-year bonds, we had a vicious sell-off. So what I covered earlier in the market commentary is that the market basically responded to easing with rates going up and it hitting the long part of the yield curve. And this is the 30-year Treasury bonds. And you can see we basically dropped from a high of 154 all the way down to 144, where we're testing and holding the 200-day moving average, as well as the relative strength index being a bit oversold. So with the confluence of these two things and the lower end of the Bollinger Band, I'd be inclined, if you're been trading on the short side along with us with the TLTs, that I would be covering some of my shorts around this area. Certainly at the first sign of any strength or bounce, this would be a good opportunity to take some profits. On the other hand, it's very possible that you're seeing the last vestiges of extremely low rates starting to play out. There's only a limited amount of impact the Fed can have on a constant basis like this of constantly lowering rates. At some point, and you may be seeing it, you're seeing the topping of the long-term trend in rates happening right before us. So this is the longest end of the yield curve. This is the 30-year bond. And then we're going to go through, let's go and look at TLTs. Now TLTs are the 20-year bonds, and you can see that that part of the yield curve, the 20-year, has actually now broken through the 200-day moving average. Now what's interesting, again, this is also oversold. So we had mentioned earlier in late July and early August about the potential topping right in here. We saw that there was a non-confirmation in volume and a reversal pattern where we put on a short position, or we bought the TBTs, which is the inverse. The market came off pretty hard. We covered some in here. We thought, and if you review the commentary over the last several market outlooks, we thought that the market was going to bounce off of this. We ran into a flat to declining 50-day moving average where we anticipated that it would find some resistance. It has, and now of course it's responded and busted through the 200-day. Now, since we are a bit oversold, we have to be cautious about a bounce, and here's where we want to take a look at the longer term or the weekly charts. And as you can see, we have the 65-week moving average, which is this blue line here, which would be some level of support. Now, in addition, you can see we've dropped a parallel or channel line, and let me improve this a little bit here. So we've got a channel, and support within this channel, especially on a closing basis, or the bodies of the candle, also come in around this 116.70 level. So for those who are playing the short here, I would be certainly looking to cover a portion, if not all of your position, looking for a potential bounce and another opportunity to get short again as we approach oversold levels, both on a weekly and a daily basis. Now let's take a look at what has happened in junk bonds. So junk bonds has actually moved up quite sharply with the announcement of QE3. So basically what the Fed is doing is it's forced people to go into higher risk things such as stocks, commodities, and junk debt. You can see the price has gone up, yields have gone down. So the net effect on the market is that people are moving into trying to lock in some level of interest, even though it's of higher risk. And as you can see, we've moved up, almost 4 or 5 ATRs in junk debt, which was quite a substantial move. And you can see breaking out of the higher end of the Bollinger Bands. And this is where you talk about a potential parabolic move. On a weekly basis, again, you have sort of this head and shoulders or inverse head and shoulders pattern playing out. The count over here would be from 37.74 to about 40, almost up to about 42.50. So you still have a lot more to go into the upside on the junk bonds. Now, looking at HYG, which is high yield corporate bonds, similar story. Not quite the volatile move that junk debt has, but it's moved pretty good. So interesting to note that riskier debt instruments have taken QE3 and responded positively, where U.S. Treasuries with much, much lower yields have been hit. I don't know if this was the desired impact that Bernanke wanted, but this is what he got. Now, furthermore, I want to take a look at one ETF, which seems to be running out of a little bit of steam. It's the IBB versus SPY. So one of the things to note is looking at the S&P and various sector ETFs. We've been talking about IBB and how it's really outperformed the S&P for quite some time. So here we are. This is a chart, a weekly chart of the IBB. Here's a weekly chart of SPY. And you can see with this last rally, it's sort of lost a bit of steam. So one of the things I'd be really cautious about is biotech stocks. And if, in fact, the weekly chart turns over, breaks through the moving average, as well as this bounce off of the last support. So let's be cognizant of that. And I think that's a pretty good wrap up for now. Hope you've enjoyed this. Look forward to seeing you next week. Again, don't forget to take the survey and to sign up to get this video and newsletter every week by going to www.marketgauge.com and sign up for this free weekly newsletter. Thanks, and bye for now.